How billionaires pay almost no taxes, legally. Hi friends, welcome back. Today we're exploring a topic that surprises a lot of people. Many billionaires, some of the richest people on the planet, legally pay very little in income tax. Sometimes far less as a percentage than an ordinary working person pays on their paycheck. This might sound strange or even unfair, but here's the important thing to understand. Most of what we're about to explain is completely legal. It's not about billionaires secretly hiding money or breaking the law. It's about how the tax system itself is built and how a few clever legal strategies take full advantage of the rules exactly as they are written. Today, we'll walk through the biggest reasons why this happens, one idea at a time, in simple terms. Let's take a look behind the curtain. The first big idea is billionaires mostly don't earn regular paychecks. Their wealth grows through stock and investments instead. Most working people earn money through wages, and income tax is taken directly out of every paycheck. But many billionaires, especially founders of large companies, hold most of their wealth in company stock, which grows in value over time. Here's the key detail. In most cases, the government only taxes money when an asset is actually sold, at what's called a capital gain. As long as a billionaire simply holds on to their stock without selling it, that growing value is not considered taxable income at all, even if it grows by billions of dollars in a single year. The second big idea is a well-known strategy nicknamed buy, borrow, die. Step 1, buy. A billionaire buys valuable assets, like company stock or real estate, that are expected to grow in value over time. Step 2, borrow. Instead of selling that stock to get spending money, which would trigger a capital gains tax, the billionaire simply borrows money from a bank, using the stock as collateral. Since borrowed money isn't considered income, this loan is not taxed at all, even if it's used to buy homes, yachts, or anything else. Step 3, die. When the billionaire eventually passes away, their heirs inherit the stock at its current market value, a rule called the stepped-up basis. This means all the decades of growth that happened during the billionaire's lifetime is never taxed at all, not by the billionaire and not by their heirs either. Put together, this three-step strategy allows enormous wealth to grow, be spent, and be passed down to the next generation, almost entirely without ever triggering income or capital gains tax. The third big idea is even when billionaires do sell investments and pay tax, that tax is often charged at a lower rate than ordinary income tax. In many countries, including the United States, money earned from selling long-held investments, called long-term capital gains, is taxed at a noticeably lower rate than money earned from a regular paycheck. A working person's wages might be taxed at a rate as high as the mid-30s%, while long-held investment gains are often taxed at a much lower rate. This means that even in years when a billionaire does sell some stock and does pay tax, the rate they pay on that specific type of income is often significantly lower than the rate an average worker pays on their salary. The fourth big idea is donating stock to charity can lower a billionaire's taxes, while sometimes still letting them keep significant control. When someone donates appreciated stock directly to a charity or a personal foundation, rather than selling it first, two things happen. They avoid ever paying capital gains tax on that stock's growth, and they usually receive a valuable tax deduction for the donation itself. Many billionaires create their own private foundations, which allows them to direct enormous sums toward causes they care about, while often still maintaining significant influence over how and when that money is eventually used. This blends real charitable giving with meaningful tax benefits at the same time. The fifth big idea is wealthy families often use special legal trusts to reduce the taxes owed when passing wealth down to their children. Certain legal structures, sometimes called grants, short for grantor retained annuity trusts, allow a person to place assets into a trust, and if those assets grow in value faster than a certain expected rate, most of that extra growth can pass to their heirs with little or no gift or estate tax owed at all. These tools are complex and require careful legal and financial planning, but they've been used by extremely wealthy families to transfer enormous fortunes, sometimes worth billions of dollars, to the next generation while owing very little tax on the transfer. The sixth big idea is certain retirement accounts, meant to help ordinary people save, can sometimes be used by the ultra-wealthy to grow enormous amounts of money completely tax-free. Some retirement accounts are designed so that money placed inside them can grow and later even be withdrawn without ever being taxed, as long as certain rules are followed. Normally, these accounts are meant for modest retirement savings, contributed a little at a time. However, in some documented cases, wealthy individuals have placed unusually valuable, fast-growing assets, like very early shares of a private company, into these accounts while the assets were still worth very little. As those assets later exploded in value, the growth remained protected inside the tax-free account, allowing a small starting investment to grow into an enormous, largely tax-free fortune. The seventh big idea is this system exists on purpose, but people strongly disagree about whether it's fair. Many of these rules were originally created to encourage investment, entrepreneurship, and charitable giving, all things most people generally consider valuable for a growing economy. Supporters argue that taxing unsold, unrealized investment growth would be complicated to calculate fairly and could discourage people from starting and growing businesses in the first place. On the other hand, critics argue that when the wealthiest people in society can grow enormous fortunes while paying a much lower effective tax rate than everyday workers, it raises serious questions about fairness. And some economists and lawmakers have proposed new rules specifically aimed at closing these gaps. This is genuinely an ongoing, actively debated topic. Different countries and different political groups have proposed very different solutions, and there's no single, universally agreed upon fix. Let's review everything we learned together one more time. 1. Wealth through unsold stock isn't taxed like a paycheck. Value can grow without triggering tax. 2. Buy, borrow, die. Buy assets, borrow against them tax-free, and pass them down with a reset tax basis. 3. Capital gains are often taxed lower than wages, even when investments are eventually sold. 4. Charitable giving and foundations. Donating stock avoids tax while allowing continued influence. 5. Special trusts. Legal structures can pass enormous wealth to heirs with minimal estate tax. 6. Tax-protected retirement accounts. Small early investments can grow tax-free into fortunes. 7. The system is intentional and it's actively debated. Some see it as encouraging growth, others see it as unfair. The biggest takeaway is this: billionaires generally aren't breaking any laws. They're using the tax rules exactly as they are written, often with the help of skilled lawyers and financial advisors who understand every detail of the system. Whether or not these rules should change is a genuine, ongoing debate among economists, lawmakers, and everyday citizens. And it's a conversation worth understanding clearly, no matter which side of it you lean toward.